Why do you have to evaluate cost of capital? It's because investors require a minimum rate of return that must be at least equal to what the investor can receive on alternative investments, exhibiting a comparable level of perceived risk. So in this cost of capital, we will evaluate the risk. There are two types of risk. The first one is the non-systematic risk. This includes market risk and business risk. And the second one is the systematic risk. This includes the inflation or natural disaster, the risk that hardly to be calculated. That is why we use beta to calculate it. Beta is included in the systematic or non-foreseeable component. To analyze beta, so when we have beta equal to 1, it means that the stock is as risky as the general market. When beta is less than 1, it means that the stock is less risky than the general market. And then when beta is more than 1, it means that the stock is riskier than the overall stock market. To calculate beta, there are two types of beta. The first one is leverage beta, and then the second one is unleveraged beta. To calculate the leverage beta, first we have to calculate the unleveraged beta times 1 plus 1 minus tax times debt per equity. And then to calculate unleveraged beta, we have to use the leverage beta divided by 1 plus 1 minus tax times the debt per equity. And then to analyze return. To analyze return, first we have to calculate the cost of equity, and then we also have to calculate the cost of preferred stocks, and then we have to calculate the cost of debt. Here, we can have the formula of cost of equity. To calculate the cost of equity, we have to use risk-free rate plus beta times risk market minus risk-free rate, and then to calculate the preferred stocks, we have to use the DPR divided by preferred stock. To calculate the cost of debt, we have to calculate it using interest times 1 minus the tax rate. And then with this calculation, we can get the weighted average cost of capital. To calculate the weighted average cost of capital, or WACC, we can use this formula. It's the cost of equity times equity per total capital plus the cost of debt times debt per total capital plus the cost of preferred stocks times preferred stocks divided by total capital. That's all from me. Thank you.